Hello traders, welcome back to Com Lucro. Today we are opening up the depth of market, or DOM, the tool that reveals what is really happening behind every price move. Underneath each candle on your chart is a live battle between buyers and sellers, and the DOM is where you finally get to see it. In this lesson, we will break down how the DOM works, what it actually shows, and how it exposes the balance between buy and sell limit orders. You will learn to tell passive limit orders apart from active market orders, a single skill that can instantly change the way you read price. And we will watch the DOM move in real time as traders place, cancel, and adjust their orders, and liquidity shifts right in front of you. By the end, you will never look at a candle the same way again. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Before we get into the mechanics, let's anchor the purpose of this lesson. The DOM gives you a live view of how price forms on the chart, showing where liquidity sits and how orders interact. It is not about trading through the DOM, it is about understanding the engine that drives every candle you see. The first concept is the difference between two kinds of orders. Limit orders are passive. You place an order to buy or sell only if price reaches a level you prefer, and it waits in the book, shaping the structure of the market without moving price on its own. Market orders are the active side. They buy or sell immediately at the best available price, consuming those resting limits, and that interaction is what physically pushes price from one level to the next on your chart. When you combine the buy and sell limit orders, you get the bid and the ask. The bid is the highest price a buyer is willing to pay. The ask is the lowest a seller is willing to accept. And the difference between them is the spread, the first space price must cross when a market order enters. The tool that displays all of this is the order book, and the DOM is simply a visual way of seeing the buyers on one side and the sellers on the other, arranged by price. Even if you never trade with it, its logic helps you interpret why candles accelerate, stall, reverse, or gap. Finally, we have liquidity. When the order book holds large clusters of limit orders across many price levels, the market becomes more stable and harder to move. When liquidity is thin, even a moderate market order can shift price quickly and create the dramatic moves that confuse beginners. Together, these concepts form the foundation of how the depth of market explains price movement, the mechanics behind every reaction on a chart, and the key to reading that behavior with far more clarity. Now that we have a clear understanding of the basic concepts, let's delve into the specifics of how the DOM functions and how you can utilize this powerful tool to enhance your trading approach. To keep it simple, let's imagine a scenario with only a few traders in the market, and we know all their actions. The market opens at 8 a.m., and the first trader enters. He wants to buy 5 contracts at a price of 98. He doesn't want to buy immediately, so he sets a buy limit order at this price, making him a passive buyer on the DOM. His buy limit order appears on the bid side with a quantity of 5 at a price of 98. 1 minute later, another trader arrives. He wants to sell 10 contracts at the price of 99. He specifies this price with a sell limit order, making him a passive seller. His sell limit order shows up on the ask side, indicating he is asking someone to buy 10 contracts at 99 per contract. The first trader is only willing to buy at 98 or lower, so his order remains on the bid side. Now, 2 more traders enter the market. Trader 3 wants to buy 2 contracts at 97, and Trader 4 wants to sell 3 contracts at 100. These new limit orders are displayed on the DOM, but none of them match, so the price doesn't move because each trader demands a different price. At this moment, we have 2 buyers willing to buy at 98 and 97, and 2 sellers willing to sell at 99 and 100. There's no agreement between them. Let's continue. Another seller, Trader 5, wants to sell 4 contracts at 99, just like Trader 2. This increases the ask size to 14, with 10 contracts from Trader 2 and 4 from Trader 5. Still, nothing happens. But suddenly, an aggressive buyer enters and says, I don't want to wait anymore. I want to buy 5 contracts now. This aggressive buyer uses a buy market order, which doesn't specify a price. The buy market order matches with the first available sell offer, which is at 99. So this aggressive buyer purchases 5 contracts at a price of 99. By doing this, he clears 5 sell limits on the ask side at 99. This reduces the ask size at 99 from 14 to 9. All these 5 sell limits at 99 belonged to Trader 2, who came first. Therefore, Trader 2 still has 5 contracts left to sell, waiting for more aggressive buy market orders at the price of 99. There are now 9 sell limits remaining. These will be filled in the following order. First, all the remaining sell limits of Trader 2, and then those of Trader 5. It's like a queue. The limit orders are sorted chronologically, following a first-come, first-served logic. Because Trader 5 came in later than Trader 2, he must wait until Trader 2's sell limits are filled. Now, an aggressive seller enters, causing the price to move. The current price is 99 because that's the price at which the most recent trade occurred. The aggressive seller wants to sell 3 contracts using a sell market order. Remember, the sell market order pairs with the first available bid from a passive buyer. In other words, it matches with the first available buy limit order on the bid side. Where is this first available buy limit? It's at a price of 98. So the aggressive seller sends a sell market order, and the passive buyer purchases from him because the passive buyer has a buy limit at 98. The price drops to match the sell market order with this buy limit. The aggressive seller sells 3 contracts, clearing 3 buy limits at 98 out of a total of 5 buy limits at this price. Since the aggressive seller cleared 3 buy limits, 2 buy limits remain at 98. Notice that the price moved down, yet the number of sell and buy orders is equal. The price didn't decrease because there were more sellers than buyers, but because the sellers were more aggressive. Now, what needs to happen for the price to move from 98 to 97? It's simple. More aggressive sellers must clear the remaining 2 buy limits at 98. Think of it as a barrier. This barrier of limit orders must be broken for the price to move. An aggressive seller comes in and sends a sell market order to sell 3 contracts. However, at 98, there are only 2 buy limits, so this barrier isn't strong enough to satisfy the aggressive seller. So what happens? 2 sell market orders match with 2 buy limits at 98, clearing all the buy limits at this price. With no buy limits left at 98, the market must move lower to find more buy limit orders, so it moves from 98 to 97. At 97, the remaining sell market order pairs with a new buy limit, completing the aggressive seller's order to sell 3 contracts. This aggressive seller moved the market down because his market order was paired with buy limits at 2 different prices. His sell market order for 3 contracts matched with 2 buy limits at 98 and 1 buy limit at 97. Notice this. The price moved from 98 to 97, despite there being 1 seller and 2 different buyers. However, the number of buy and sell orders is equal, a sell market order for 3 contracts and buy limits for 3 contracts in total. Now, what do you see? At the price of 98, there are no sell limit orders. Remember, a market order doesn't specify the price. The price at which the market order is filled depends only on the availability of limit orders. So where are the first available sell limits? They are at 99. An aggressive buyer now enters, wanting to buy 1 contract using a market order. The actual price is 97. There are no sell limits at 98, and the first available sell limits are at 99. Despite the actual price being 97, the aggressive buyer is filled at 99 because that's where he finds someone to buy from. He moved the market up from 97 to 99 because there was no liquidity at 98, no sell limit orders, so the market skipped this price and moved straight to 99. This is called a gap. The market gapped up from 97 to 99. The aggressive buyer experienced what's known as slippage. He bought at a worse price than he expected. He sent the buy market order when the actual price was 97, expecting to be filled at 98 because logically there should be some sell limits. In reality, there were no sell limits, so the market gapped up and he bought at 99. This means he got a worse price and experienced slippage. So in this situation, there was 1 buyer and 1 seller, 1 buy market order and 1 sell limit order, and the price moved from 97 to 99. Now, let's look at the final situation. A big trader comes in wanting to buy 15 contracts. Meanwhile, more passive sellers have appeared and sent their limit orders into the market. The last price is 99, the price at which the most recent trade took place. This is the price the big trader sees when deciding to send his order into the market. This big trader uses a buy market order to purchase 15 contracts. By doing this, he moves the price from 99 to 103. You can see how his market order for 15 contracts was paired. Take a moment to observe this. There was one buyer and many sellers, and the price moved by 4 points. However, the quantity of buy and sell orders was equal. 15 contracts to buy and 15 contracts to sell. This is always equal, and this is how the price moves. However, in reality, such a big trader is likely to use a limit order to open a trade, because he trades such large positions that the potential slippage when using market orders is significant. To sum it up, price moves through the interaction between market orders and the limit orders available to fill them. Those limit orders act like a barrier, and only when a barrier is not strong enough to absorb the incoming market orders does price move to the next level. Yet the number of buy and sell contracts is always equal. In our last scenario, price ran from 99 to 103, with 15 buy market orders matched by 15 sell limit orders. And that is the real value of the depth of market. By showing where liquidity rests and separating passive order flow from active order flow, the DOM helps you spot potential support and resistance, understand why price accelerates or stalls, and make more informed decisions. Master these mechanics, and you gain a real edge, reading the market straight from the engine that actually moves it. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.